Affordable housing finance companies primarily cater to self-employed individuals within the unorganized sector with low or middle income customers. These companies specifically target first-time home buyers utilizing self-occupied residential property as collateral. The average loan amount typically falls between 10 to 15 lakhs. Most customers within this segment lack credit scores and often cannot provide mandatory income proof documents that are typically required by large banks for loan applications. These customers are predominantly situated in rural and semi-urban regions. One such company is Home First Finance, a technology-driven affordable housing finance firm with a nationwide presence. Home First Finance focuses on first-time home buyers with a prominent emphasis on salaried individuals earning less than 50,000 per month. Approximately 87% of their loan portfolio comprises home loans with an average loan size of 11.2 lakhs. The company places strong emphasis on digital adoption, a key area of concentration. In Q1 FY24, 93% of customers were registered on their app, 91% of service requests were submitted through the app, and unique user logins accounted for 55%. Notably, the company is renowned for its remarkable 48 hours turnaround time for loan approvals. Home First Finance has developed an end-to-end digital process for home loans revolving around four core pillars: mobility, digital marketing, data analytics, and technological infrastructure. On a different note, Aavas Financiers is headquartered in Jaipur, Rajasthan, and commenced operation in March of 2012. Over the past decade, Aavas has undergone several transformative business initiatives. During Aavas 1.0, the focus was on testing the viability of the affordable housing finance model under AU's ownership. In Aavas 2.0, the emphasis shifted towards refining the model and establishing a strong foundation to facilitate scaling under private equity ownership. Presently, Aavas 3.0 is underway, concentrating on expansion and institutionalization. The company is currently undergoing a substantial digital and technological transformation, involving the implementation of a novel digital loan organization platform and customer service system under Salesforce. Additionally, they are adopting a new loan management solution through Oracle FlexCube and a cutting-edge cloud ERP system for automating back-office processes. Aptus, established in 2009 and headquartered in Chennai, is a leading housing finance company specializing in providing accessible and affordable housing loans. They primarily operate in the southern states of India. Aptus focuses on serving first-time home buyers, particularly those who use their self-occupied property as collateral for the loan. On the other hand, Aavas conducts all of its lending operations internally, which allows them to directly engage with customers, minimize processing time, and reduce the risk of fraudulent activities. Their main customer segment comprises self-employed individuals, with a significant portion of loan disbursement accounting for 72% in FY23, catering to this group of borrowers. All three companies have demonstrated remarkable growth in asset under management over the past decade, boosting a noteworthy CAGR of 35%. Aavas witnessed its AUM surge from 843 crore to 14,000 crore in 2023. Similarly, Aptus witnessed growth from 252 crore to 6,700 crore, and Home First experienced an increase from 163 crore to 7,200 crore in the same period. Notably, the bulk of this growth transpired between 2021 and 2023. In terms of disbursements, both Aavas and Aptus achieved a CAGR of 28%, whereas Home First outpaced them with a faster CAGR of 47%. Interestingly, the majority of this growth also occurred between 2021 and 2023. Across the board, all three companies witnessed substantial profit growth over the last decade. Aavas profits escalated from 19 crore to 428 crores, reflecting a CAGR of 41%. Similarly, Aptus saw its profits soar from 6.26 crore to 503 crore, achieving a CAGR of 55%. Home First profits surged from 2 crores to 228 crores, resulting in a remarkable CAGR of 60%. In terms of yields, Aptus stood out with the highest yields among its peers, reaching 17%. Aavas and Home First posted yields of around 13%. When considering the cost of borrowings, Aptus recorded 8.1% in 2023, followed by Aavas at 7.6% and Home First at 7.4%. Capital adequacy ratios were consistently maintained at impressive levels across all three companies. Aptus boosted a ratio of 77%, Aavas was at 46%, and Home First reported 49% as of FY23. Turning to return on assets, Aptus demonstrated a remarkable increase from 3% in 2014 to 8.44% in FY23. Aavas posted an ROA of 3.5% in 2023, while Home First achieved an ROA of 3.9%. Aptus also stood out in terms of return on equity, registering a robust 16% in 2023. Home First's ROE improved significantly from 3.8% to 13.5% in 2023, and Aavas saw its ROE grow from 10% in 2018 to 14% in 2023. In regard to asset quality, Home First faced higher gross non-performing assets than its peers, reporting 1.6% in 2023. Aavas posted 0.92% and Aptus reported 1.15% during the same period. Aavas displayed robust branch expansion, witnessing a notable increase from 94 branches in 2017 to 347 branches in 2023, achieving a CAGR of 20%. Aptus experienced branch growth from 80 in 2017 to 231 in 2023, recording a CAGR of 16%. Meanwhile, Home First observed branch expansion from 36 in 2017 to 111 in 2023, demonstrating a CAGR of 17%. Notably, Home First's branches are spread across 10 states, with a substantial 32% of its business originating from Gujarat. Following closely are Maharashtra at 14%, Tamil Nadu at 13.9%, Telangana at 8.9%, and Karnataka at 7.1%. A deeper dive into Home First's asset under management composition reveals that 87% of their AUM comprises home loans, with 12% attributed to loan against property. Their lending portfolio is distributed with 69% of loans extended to salaried individuals and the remaining 31% to self-employed individuals. Home First's primary focus lies in ticket sizes below 25 lakhs. Ticket sizes of 5 to 10 lakhs contribute 27% of their AUM, followed by 10 to 15 lakhs at 32% and 15 to 20 lakhs at 18%. Aptus primarily operates in South India, generates approximately 42% of its business from Tamil Nadu, followed by Andhra Pradesh at 36%, Telangana at 14%, and Karnataka at 8%. Within Aptus, home loans contribute 59% of their loans, followed by quasi-home loans at 16% and small business loans at 21%. Aavas, however, maintains a distinct focus solely on home loans, with 69.8% of their AUM attributed to this category. Other mortgage loan account for the remaining 30.2%. In terms of borrower categories, close to 60% of Aavas's loans are provided to self-employed individuals, while salaried individuals account for remaining 40%. Aavas underwent a notable reduction in promoter stake, decreasing from 50% in September of 2020 to 39% in June 2023. Foreign institutional investors also reduced their stake by nearly 5% since December 2021, currently standing at 35%. During the same period, domestic institutional investors increased their stake by 5% to reach 14%. Public holding in the company amounted to 11.5% as of June 2023. In the case of Aptus, promoter holdings have remained steady at 62.5% over the past 3 years. During this period, FII's shareholding increased from 10% to 14%, while DII's stake witnessed a significant reduction from 20% to 3%. Interestingly, public shareholding experienced a substantial increase, rising from 7% to 21%. Home First observed a promoter stake reduction of 3.2% in the June 2023 quarter, resulting in a lowered stake of 30%. DII significantly reduced their stake from 43% to 6.5% in September 2022. However, DIIs have consistently increased their stake since then, reaching 10% in June 2023. Over the past 3 quarters, FIIs significantly increased their stake, escalating from 9.37% to 17.5%. In Q1 FY24, Aavas predominantly secured its funds through term loans, accounting for 45% of its funding, followed by 22% from assignments, 20.8% from NHB refinancing, and 12.2% from non-convertible debentures. On the other hand, both Aptus and Home First rely heavily on bank borrowings, with 60% and 57% of their funds respectively originating from this source. Both these companies also make use of NHB refinancing options, with Aptus raising 26% and Home First raising 22%. Furthermore, Home First diversifies its funding sources by obtaining 17% of its funds through DA co-lending option. A noteworthy point is that all three companies steer clear of raising funds via commercial papers, which are short-term borrowings. Instead, they predominantly secure funds through long-term borrowings. This strategic approach ensures efficient asset and liability management. Consequently, all three companies exhibit a positive asset to liability relationship across various time frames, ranging from 1 year to 10 years. This reflects their prudent financial planning and commitment to maintaining a sustainable balance between their assets and liabilities. In 2023, India surpassed China to become the world's most populous country. This growth in population has resulted in an increasing demand for households, consequently creating an expanding lending opportunity. Forecasts indicate that India's working age population is projected to reach 988 million by 2036, further driving the growth of the affordable housing sector. A technical study conducted by the Ministry of Housing and Urban Poverty Alleviation revealed an estimated urban housing shortage of 19 million homes in 2022. This gap is predicted to widen to around 38 million homes by 2030 due to population growth and increased urbanization. As of 2022, India's mortgage penetration was at 11% of the GDP, notably lower than other Asian economies which stand at 20 to 30%. However, with the escalating demand, experts anticipate that India could potentially double its home loans to USD 600 billion by 2027. The Indian government has demonstrated its commitment to addressing the need for affordable housing by announcing a Rs 48,000 crore allocation under the Pradhan Mantri Aavas Yojana. To enhance urban infrastructure development, the Indian government has proposed the establishment of an Urban Infrastructure Development Fund. This fund is intended to facilitate urban infrastructure development in Tier 2 and Tier 3 cities through public agencies. Managed by the National Housing Bank, it is expected to have an annual allocation of around Rs 10,000 crores. Various initiatives are expected to propel the housing sector, including the interest subvention scheme, interest deduction from taxable income, tax exemption from principal repayment, and capital gains exemption. Projections indicate that India's urban population will reach 675 million by 2035, accounting for 43.2% of the country's total population. This shift is anticipated to trigger increased demand in the housing and housing finance sectors. Home buyers in India are subject to a goods and service tax when purchasing under construction properties. The GST rate stands at 1% for affordable housing, while properties under the luxury residential building category are subjected to a GST rate of 5%. Aptus is poised to further solidify its dominant position in the states of Telangana and Andhra Pradesh, while simultaneously expanding its footprint in the newly ventured state of Odisha. In the upcoming quarter of Q2 FY24, the company has strategic plans to make an entry into Maharashtra. Moving forward, Aptus is set to add 30 to 35 new branches in the fiscal year of 2024, resulting in a cumulative count of 265 branches. 15 of these new branches will be in Telangana, while concurrently the company will adopt a systematic approach to expansion in Maharashtra and Odisha. Anticipating growth, Aptus aims to achieve a 30% increase in asset under management by the conclusion of the fiscal year 2024. The management remains optimistic about maintaining the cost of funds at a steady 8.3% for the same period, with no projected increases. Despite the extensive expansion of branches, Aptus remains committed to optimizing its cost structure, striving to uphold a cost-asset ratio ranging between 2.6% and 2.65% in fiscal year 2024. Furthermore, the company is poised to sustain its exceptional return on asset performance, projecting figures of 7.5% to 7.8% over the FY24-25 timeline. With an extensive decade-long experience in underwriting for the underserved self-employed segment, Aavas has effectively carved out a specialized niche in the AHFC sector. Backed by one of the most expansive distribution networks, encompassing 346 branches spanning across 13 states, Aavas has set forth plans to inaugurate an additional 30 to 35 branches annually. Leveraging its diverse funding mix, ability to secure competitive funding rates, and versatile omni-channel sourcing arrangements, Aavas is poised to deliver AUM growth exceeding 20% in the forthcoming years. Aavas 3.0 commenced transformation projects Gati and Unnati to reduce TAT from the current level of 10 to 12 days to 6 to 7 days for better customer experience and be future ready. Home First Finance has ambitious goals for the fiscal year 2024. They are targeting asset under management growth of more than 30% and plan to surpass the Rs 10,000 crore AUM milestone within the next 12 to 15 months. The company remains dedicated to catering to high loan amounts, primarily in the range of 15 lakhs to 25 lakhs and above 25 lakhs. To support their growth strategy, Home First Finance intends to expand its branch network significantly, with plans to add 130 new branches by the end of the fiscal year. Additionally, they are striving to achieve an impressive return on equity in the range of 15 to 16% for FY24. These targets reflect their commitment to expanding their business and enhancing profitability. If you like my content, then please write in the comment box companies from which sector you would like me to analyze.